Welcome back to our intermediate financial accounting class. In our last few segments, we've been focused on leases, and we've had so much fun talking about leases. We've talked about the way that we calculate them, why they're important, what the journal entries look like. Oh, we've gotten to do so many cool journal entries. All this fun stuff about leases. Now we get to wrap up with just a last couple of conceptual issues that we need to feel comfortable with, and then we're going to do one last example, and that will finish up our discussion. So hopefully you're ready to do just a little bit more. Again, these are important issues for the accounting profession as a whole, as well as for finance and for business. There's a lot going on here. And I tried to think of a joke that I could use to segue into this, and I really couldn't think of one. I don't know why. There's just so much fun stuff already going on. I guess it's just blotted it out of my mind. The only thing I guess I can tell you is I was recording this earlier in the day while my family was out running some errands, and then they came back and we had dinner and I got ready to record again, and I came down the stairs and I told my daughter, I'm going to record, do you want to stick around and hear it? And she made some comment about me being boring, and you should have seen her zip up the stairs. I don't understand that. Accounting and leases, they're so cool. I just don't understand that girl. Why, a 14-year-old girl wouldn't be fascinated by this, but that's all right. I've got time. I'll work with her. We'll get her there eventually. Anyway, let's move right on to these last couple of conceptual issues before we do our example. And we've already talked a little bit about residual values and bargain purchase options, but I just want to emphasize them a little bit. First, a residual value in general is what the lessor thinks that asset is going to be worth once the lease is done. There are 4 ways that a lessor can treat that residual. Option number 1 is they assume it's going to be 0. This is like a rent-a-sender type deal where we simply let you keep it. You rent to own it, and once you're done making your lease payments, the asset is yours. So we assume the residual is 0. Option number 2, I don't want to have to sell it to somebody else. If I offer you a discount, maybe you'll take it off my hands and I'll just be done with it. That's what we call a bargain purchase option. And as we've mentioned, a bargain purchase option means it's got to be a deal. It can't just be that you get the right to buy it first, or you get the right to re-up and do a new lease. It has to be a bargain. So it's worth $50,000. I'll sell it to you for 40, 35, or 25, or 10. That's the bargain purchase option. It's not a bargain as far as the lessor is concerned. I'm going to get my $300,000 or $100,000 or $1 million, whatever it is, one way or another. If I give you a bargain at the end, it's because I've charged you more all through the lease to make sure I get my full market value. So it's not a bargain from that perspective. It's simply at the end of the lease, you're going to pay less than what we think the fair market value is going to be on that day. The next option is what we call a guaranteed residual. That's where, as we sign the lease, I go to you as the lessee and I say, I'm willing to lease this to you, but you're going to have to agree that it comes back to me in good shape. We've all done this when we've loaned stuff to siblings or to other members of the family, when we've loaned to a roommate, or take my car, but there better not be a scratch on it. That's a guaranteed residual. You promise you're going to bring it back to me in some kind of specified condition. If it's not, you're going to pay me the difference. So I loan you my car, you scratch it, you're going to pay to get it right again before I take it back and let you off the hook. That's a guaranteed residual. With a guaranteed residual, the lessee is going to include that guarantee as part of its payment. I'm not just making these 4 payments for my lease, but I'm also going to give you an asset or cash worth that guaranteed residual. I'm on the hook for it. I record it as part of my lease liability and part of my right of use asset calculation as well. Also, when I do my amortization or depreciation of the asset, I'm assuming it's going to be worth that residual value at the end. So I'm going to depreciate it just down to that guaranteed residual amount. That's what the lessee does that's different. From the lessor's perspective, if it's an operating lease, it doesn't make a bit of difference. I don't even care. I'm assuming I get my residual one way or another. Either I get it from you or I'm going to sell it to somebody else. I don't care. If, however, it's a sales type lease, then I'm going to include that guaranteed residual as part of my lease receivable. And I take it out of those unguaranteed residual value calculations, so that special table that we made separately. Because now it's guaranteed, I don't have to unwind the discount. The payments from the lessee are going to unwind that discount automatically. For both the lessee and the lessor, a bargain purchase option, again, we treat that just like a really small guarantee. So the journal entry effects we've talked about apply to bargain purchase options as well. Now the last option for the lessor is an unguaranteed residual. That's where the lessee simply won't guarantee that it's worth a certain amount. They'll try to keep it nice, but I'm not going to commit to it being nice. That is what we've already done in our examples. So the lessor still assumes it's going to get that amount. It still takes it out when it calculates the payments that it's going to receive from the lessee as part of that calculation of what the lease payment should be. The lessee does nothing at all with it because I don't care. I don't care what it's worth at the end. That's not my problem. It's the lessor's problem. I'm just going to use what I want, and then I'll return it in maybe bad shape if I don't care, good shape if I hope to lease from them again someday. Hopefully, from an ethical perspective, you take good care of it anyway because you know it's not yours. But that's the attitude that I sometimes see with my children when they borrow stuff from me. If they know I'm going to hold them accountable, they take good care of it. If they know I don't really care, it tends to get trashed. So anyway, that's the idea between these four options that the lessor has when setting up the contract with the lessee. And we've already seen the unguaranteed residual. We'll do a bargain purchase option as part of our comprehensive example. And also there's a DGS example that walks through all 5 of the various options for setting up a lease, including a short-term lease. So if you want to practice all the different kinds, you can see it in DGS. Now before we get on to our comprehensive example, let's take just a minute and talk about IFRS for leases. IFRS only has one category under the new rule. They passed theirs at about the same time FASB passed our new GAAP rule. They call them all finance leases. The contract has to decide if the new contract is a lease or a service agreement. That's their other option. If it's a service agreement, then they have totally different accounting rules. But if they decide it's a lease, then the rules are pretty similar to what we've looked at as financing or sales type leases for the lessee and lessor. Also, IFRS allows more leases to be classified as short-term leases if the asset's market value is less than $5,000, regardless of how long you're going to own it. And if it's not related to or dependent on other leased assets, then you can call all of those short-term. So as opposed to FASB's rule 12 months or less, IFRS is allowing us more flexibility. Now that's the last of our conceptual material. When we come back, we'll be talking about our last example, a comprehensive walk through a bargain purchase option lease. We'll look at it from both the lessee and the lessor's perspective. A lot of fun journal entries and calculations coming up with that. We'll see you then. Thanks.